also feedback from industry players in India and globally. Coming to our existing facilities, as indicated in the past, we continue to drive operational excellence while executing projects in a disciplined fashion within a tight financial framework. In particular, our HS plant, R32 plant, R22 plants are running at optimum capacity. We continue to work jointly with Honeywell to ramp up our plant at Dahej, though this is taking longer than expected. However, we are hopeful of putting this behind us soon. The agro specialty plant at Dahej is progressing well, with chemical charge expected by end of March-April, followed by first commercial supplies by end of Q1 FY25. Our AHF project at Dahej is progressing well and is as per schedule. A capex of 30 crores towards development of a completely new capability in Surat is on track and is expected to generate revenue from FY25. I am also pleased to inform that with a view to incentivize and retain critical talent, the NRC and the board have granted 2,27,500 options under the ESOP scheme at the prevailing market price. The options are awarded to a small pool of critical resources across our organization. The board and I also have progressed on the search for a new CEO. We have shortlisted a pool of candidates that are being further evaluated and hope to conclude the process soon. Our key criteria remains unchanged. The candidate must have strong industry experience with an execution excellence bias and solid understanding of the growth drivers. Finally, I'd like to end by stating that the quarter has been a tough one, not just for Navin, but for the entire industry. Globally, unpredictable weather conditions, destocking of high-value inventory, and cash flow management from ag majors have impacted the entire industry. Global agrochemical players are cautious on forecasting of new demand, resulting into headwinds for the Indian ag chemical players. We expect clarity on demand visibility by Q1 FY25. However, our mid and long-term view of the business remains intact. Our focus is to continue to drive operational excellence while making investments to ensure that as and when the short-term headwinds turn, Navin is well positioned to capitalize on the same. With that, over to you, Anish.
Thank you, Vishal. Good evening and thank you all for attending the earnings call. The revenue and profitability in Q3 FY24 were below our expectations. Let me take you through business-wise performance for the quarter. Our specialty business was impacted due to deferment of campaigns and inventory restocking within our customer channel partners. On the positive side, we have added a new molecule in the last quarter at Dahej and 4 more molecules are in pipeline for the next quarter. We are confident with the strong partnership and technology platform, we will continue to deliver innovative offerings to the customers. Our HPP business was impacted due to ramp-up challenges for our HFO plant. We continue to work closely with our partner to further improve and enhance productivity of the plant. Ref gas, in particular R22, continues to face pricing pressure, especially in the international markets. We expect the pricing to stabilize by the end of the fiscal. The R32 plant commissioned earlier in the year has stabilized and is operating at an optimal capacity. Our CDMO business revenues in the last quarter were below its potential. This business is lumpy in character, hence we cannot analyze the performance on a quarter-on-quarter basis. Some of the key campaigns from the last fiscal are deferred and a couple of early phase molecules dropped off from clinical trials due to data not meeting the defined endpoints. As indicated by Vishal Bhai, the expanded MSA with European-based API customer and the strategic partnership with US-based CDMO are promising and expected to contribute along with renewed business development effort to the growth from second half of FY25. Moving on to financial performance of the company in Q3 FY24, the sales in this quarter were impacted largely due to the following reasons. Lower sales in CDMO segment, which is a higher margin business vertical. slower ramp-up and stabilization of production at Dahej, lower orders in specialty due to global inventory destocking, pricing pressure in exports markets for R22, deferment of sales from 4 specialty molecules from Q3 FY24 to Q4 FY24. Lower than expected sales resulted in decline of EBITDA margins reflected in the lower operating leverage. However, approximately 3 to 4% of the margin impact is due to one-off fixed costs, deferral of specialty molecules and delayed stabilization of which we expect to recoup. Further, as market conditions improve, we should start to see EBITDA margins rebound to the 24-25% range. I will now share the highlights of our performance for Q3 FY24 and 9-month FY24, post which we will be happy to take questions from all of you. For 9-month FY24, on a consolidated basis, the company reported revenue from operations of rupees 1,465 crores as against 1,380 crores in 9-month FY23, reflecting a growth of 6% year-on-year. Operating EBITDA stood at 288 crores as against 349 crores in 9-month FY23, down by 17%. Operating EBITDA margin stood at 9%. Crores. Focused efforts on reduction of working capital has secured the release of about 253 crores cash during 9-month FY24. Net working capital days remain within the 90 days of sales guideline provided earlier. Our net debt to equity ratio at the end of December stands at 0.38 times. The two new capexes that Rishabh Bhai referred, aggregating to rupees 372 crores, will be fully funded through internal accruals. So that is it from my side. We will now open the floor for question and answers. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Good evening, gentlemen. Thank you. A couple of questions, one on specialty chemicals and one set of questions on CDMO. In Spec Chems first, if you could please help us with an update on some of the key growth projects we've been implementing. So, what exactly is the capacity utilization of the multipurpose plant, and how do we see it ramping up next year? Do we still expect it to hit full utilization in CY24? Also, any discussions with the customer for the dedicated plant, which is already running at optimal capacity, to double the capacity there or expand? And finally, the 5 new molecules that you've talked about, one introduced this quarter, maybe there's 4 more next quarter. What might be the revenue potential from these?
Abhijit, Tanish, thank you for the questions. So on the capacity, as you know, we never generally talk about capacity, but what I will tell you is that in the Spec Chem space, we had 3 capexes. One was the MPP1 at Dahej, then there was the MPP2 at Dahej 2, and the agro-speciality plant, dedicated agro-speciality plant, part of it which is dedicated. So on MPP1, in kind of FY24, we expect that 80% of the peak annual revenue that we'd indicated to you guys will be met. In MPP2, we believe that in FY24 we will have already achieved the peak annual revenue. The dedicated agro specialty plant is expected to start chemical reaction by end of March or early April latest, and the first commercial supplies are expected to be in end of 1Q FY25. So I don't know if that answers your questions on the capacity or new agro capexes in the spec chem basis, but I'll take your question on the molecules in a second. Let me know if you've got anything more on that.
No, that's helpful, Anish. So just to clarify, the multipurpose plant for which we had a revenue potential of about 270 crores, that one is running at about 80% in fiscal 24 itself, you said, is it? And the other one, which was 160 crore revenue potential, that one is at full utilization for fiscal 24.
Yeah, so that's exactly right, Abhijit. So, I mean, I wouldn't say 80% capacity, but I'm referring to the 80% peak annual revenues, yeah?
Okay.
Okay.
Understood.
Because you know, when we factor in or model these multipurpose plants, they're not modeled to run at 100% capacity, right? They're modeled with a certain utilization level, given that there will be batch processing. Yeah.
Okay, so of the 270, we are talking about 80% here.
Yeah. On the 5 molecules that you mentioned, 1 molecule has come into play in this quarter. 4 we were expecting in this quarter. Some of that has been deferred to next quarter because of customer requests, and some of that has been deferred because we needed more time on the chemical reaction side. But we expect all of those to come into play by the end of Q4.
Yes, and any revenue potential from these that you could share?
I would not like to speculate that at this stage. Leave it to when we get to see it, yeah?
Got it. And just the other one I had was on CDMO. So while we've talked about the capex number for this MSA with the European customer, is there a revenue number also you could point at? And the other one was just that there was this large purchase order of $60 million that we had a year back or so. We were expecting some renewal of that order in CY24. So if there's any update on that.
So on the CDMO side, see, we normally that business is not associated with guaranteed MSAs or contracts, right? But so if your question was around as to what is the capacity, that's difficult to, I mean, in terms of the revenue potential you're looking for. See, our typical asset turns in CDMO tend to be about 1.75 to 2 times. So that wouldn't be sort of different here either. But, neither the MSA nor the projections are sort of guaranteed. The thing I can tell you is the commercial product that these intermediates go into is a patented product, and, the prospects are extremely promising, and we are very excited with it as well.
Sure. And on the purchase order, any update on that for upcoming year?
Purchase order for?
There was a $16 million PO we had about a year back, and we were expecting a renewal of that order in CY24. So
that order has been deferred to this quarter, coming Q4 quarter, the $18 million.
I see. So 4Q FY24 will have an $18 million delivery.
Sorry, sorry, you are referring to the last year that we've done the molecule in Q4, is it? Is that what you are referring to?
Yeah, Q3 and Q4 of last year.
Yeah, so that, as I mentioned in my commentary, those campaigns are not expected to come in this fiscal. They will come in the following fiscal. Sorry, just to clarify that, yeah?
Yeah, that's fiscal 25, right? The upcoming year, 24-25.
Yeah, correct.
Okay, so we do have that visibility now clearly defined, that order is coming next year.
We expect, it's still kind of, how the business is, right? I mean, at the end of the day, the update we have at the moment that it is expected next fiscal, but we constantly remain in touch with the customers and projections could change. There's a lot of dynamism involved in this. Abhijit.
Understood. Thank you so much, Anish. I'll get back in the queue for more. Thank you.
Sure.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So my first question is on the HFO project. So just wanted some understanding. When we started the project within a period of 3 to 6 months, we went up to the optimal utilization. And now in the last 3 quarters, we've been struggling to again get back to the optimal level, or the ramp up is slow. So is there any deferred demand issue, or is there any structural issue at plant level? And how do we foresee in terms of the revenue potential, which earlier we were envisaging about 400 to 500 crores annually, whether we are on target for that in FY25 or that is also deferred? Thank you.
All right. So let me take that in 2 parts. First is the HFO project, as you mentioned, about the ramp up and the stabilization of the production. Now, the plant is a very advanced technology plant. Honeywell operates this plant apart from obviously with us in India, in China and in the US. And, one of our learnings out of this has been that the optimum operating parameters of this plant is in a very, very narrow range. So as we experience issues, we have to be very precise in terms of how the plant parameters are being set. And that's a learning experience. Unfortunately, we did not take into account as we started the ramp up and the technology absorption. So that has taken a little more while than what we would have liked to have. But there are no structural problems. We're very closely working on this with Honeywell to resolve and fix it. And we hope that this will be behind us very, very soon. Yeah. So that's the first part of the question. The other part in terms of, is there on the demand side. Now, while we are being able to dispatch and meet Honeywell's requirements on what they have from us as a result of the contract that we have, the demand obviously also is slightly subdued. So it is the orders at the moment are at the minimum level. We are now complementing them with commercial stage molecules, right? As we go on into next year, our expectation is that about 30 to 35 to 40% of the revenues will come from commercial stage molecules. And this is where our entire team is focusing efforts on. We will have some contribution from the European based API customer into next year's revenue, though of course that revenue will come in materially or start to make material impact on the numbers from FY26. Additionally, the strategic partnership that Vishad Bhai referred with the CDMO in US will also open up opportunities. But all those efforts are ongoing. This is obviously going to be in addition to any order that we get from ongoing campaigns. All these efforts are going to be in addition to that. But, I wouldn't sort of be able to put a number on it at this stage.
Sure. Thanks for answering all the questions and best of luck, sir. Thank you.
Thanks.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
For my question. Hello?
Sorry to interrupt. You are not audible.
Can you hear me now?
Yes, this is better. Please go ahead.
Yeah. Thank you. Thanks, Vishad Bhai, and thanks, Anish sir, for taking my questions. I got few of them. First, on the R32, we thought that R32 capacity addition was freezed in December 23. Can you just help us understand the regulation now that we are going to expand? Will this qualify for the quota determination period, because this capacity is coming after December 23?
Okay. You want to finish questions or should I take them one by one?
So let's take one by one.
Okay. So the regulation around the December 23 date is actually for receiving subsidy under the Kigali agreement. The quota period is the average production you have in 24, 25 and 26, 27 being the unrestricted year, and from 28 I believe the quotas kicking, with 32 being the first year of phase down at 10%.
Correct.
So
this capacity will not qualify for subsidy payout, but this whatever we sell from this plant will qualify to get the baseline capacity for the next.
That's right. So the baseline capacity will increase. Our position, our ability to tap into that market remains intact. So yes, you're right. The numbers, the production will factor into the quota determination.
That's fairly clear. Got the regulation clear now. The second is on the gross profit margin. Sequentially, it is down by 500 basis point in the standalone entity, close to 430 basis point, while the mix in the CDMO business has improved. Anish, sir, can you help us understand what is driving down the margins in this quarter despite having a higher CDMO contribution?
So if you're referring to standalone, right?
Yes, standalone. As well as console as well. Console also we had a equivalent decline in the gross profit margin, which is your...
Right. So on standalone basis, there's sort of main drivers over there of lower margin are really the ref gas environment. There's the pricing sort of pressure in R22, which has sort of affected it. The fluorspar prices, we had high value inventory in stock, which has kind of played into it as well. Of course, as we deplete that stock, we expect that to be recouped from next financial year. In addition to that, we had some one-off charges in the business. So, if I look at your 20 to 15, as you said, sequentially, right? 5% roughly. That 5% broadly is split out in those three compartments, about 1% being on start prices, about 1.8 to 1.9% being on R22, the reasons I talked about, and about another 1.4% relating to one-off charges. So most of this, Sanjesh, we expect to recoup. As you can obviously, as these events play out, most of them, that loss margin will be recouped over time.
Just one follow-up on this, Anish sir. I thought fluorspar prices have actually gone up. That means excess inventory should have positively benefited us on the gross profit, right?
No, so fluorspar prices have gone up, but it depends on what our contracts are, right? I mean, if you look at it, the material that we are now consuming is the higher fluorspar price. If you know, when we started off, I think at the end of March 23, we had high inventories of low fluorspar prices. So that inventory is depleted and the new fluorspar inventory has come in, which was our contract from the last calendar year. And which is why I said we expect this to be recouped, because as we go forward, we'll again see the benefit of low spar prices come back into the play.
Got it. Again, sorry, I'm sticking to few bookkeeping questions to get the modeling right. The other expenses has also gone up sharply quarter on quarter. Any particular reasons for that, or it is largely to do with the HFO plant getting corrected in the Dahej and that's been booked here?
So the other expenses that you see in the, as reported, comprises both of production-related expenses as well as fixed costs. As I've already told you, there is an element of one-off costs within that. But the way I would hold it for your modeling purposes, if you take the 9-month number, right, and you look at the quarterly allocation, I'm talking console level, yeah. I mean, I'm not talking standalone. If you take that at a console level, that broadly should be the number that we should look at. So, 120 to 130 crore per quarter, roughly.
Okay. No meaning in looking at this quarterly number. It's better to look at 9.
Yeah, because there are effects, right? I mean, in some quarters we do something. Like this quarter, we may have a higher CSR spend compared to last quarter, etc. So those timing effects also come into play, yeah?
Fair enough. I got few smaller questions. One on the peak revenue from the HFO. I thought last time when we met, we said that the peak revenue because of the currency as well as the higher raw material prices now stands at rupees 5.5 billion. But in your commentary in the previous question, you showed for peak revenue being at 4.6 billion. What has changed in last 2-3 quarters to
No,
down?
so I'm referring to peak revenue on the basis on which we made the promise to the market, on that basis, saying that we had talked of, if you remember, I think it was 2,800 crores over 7 years or something like that.
Correct.
Right? So I'm saying that on that basis, when we talk of 2,800 crores over 7 years, what we are expecting to see in FY25, we will largely see that would be met.
So we will be doing a 4,460 crores in FY25.
Yes. That's our hope, yeah? That's where we are today.
That's what we are looking at today. Fair. That. My last one is on the dedicated facility. I think dedicated facility we ramped up completely. Now we are talking of an 80% utilization. It's more of a timing issue that 80% in
So Sanjay, just to clarify, the dedicated capacity, as you rightly mentioned, has already been ramped up, and FY24 itself we would have achieved the peak revenue that we'd indicated. The multi-purpose plant, which is not dedicated, I said 80% of our top line revenue, the peak revenue that we'd indicated, we expect to see in FY24 itself.
That's fine. I think I got confused between the two plants.
No worries.
So one last question on the CDMO. Previously, we said that we will be able to achieve that 100 million revenue from existing CGMP 1 to 3, and CGMP 4 will help us expand from there. And
so that sorry, I don't mean to butt you, but yeah, finish your question.
No, that's I got you got the question, and that's what I was.
Okay, no. So what we said was that 1, 2, and 3 would not be sufficient to take us to 100 million. We would need a 4. If you see what we've done is, while announcing the capex for 4 at 288 crores, we have opened up phase 1, which we believe is very, very critical to support the MSA that was referred by Vishad Bhai. And that not only supports the MSA, but also unlocks our ability to achieve that 100 million. So it's a double side thing that you will see just with that portion of the capex.
And we still hold that by FY27 we should be hitting that $100 million kind of.
So that is directional, okay? That is directional. It could be 27 or 28. Would I worry about it if it slipped by a year? I wouldn't care about it, I mean, directionally we are there. Does pace matter?
No, that's very difficult to predict, but I got the point.
Yeah, so the idea is today we are investing in the business with that as an aspiration, yeah?
So Sanjay, just one thing to add from him is that the sheer fact that in this market we are going ahead with the calculated investment in this business is the belief that the management and the customer have the the understanding and the belief in us that we can deliver, we are the right partner of choice, and that this business is going to increase going forward. And that time, if we go ahead and invest, we will lose out because customers today are looking at capacity. They cannot wait if the molecules are flying off. So it's our definite belief that going forward, this business has to reach the optimum levels that you have discussed with management.
Got it. That's all from my side. Thanks, Vishad Bhai. Thanks, Anisha, for answering all the questions. And best of luck for the coming quarters.
Thank you. The next question is from the line of Siddharth Gadekar from Equirus. Please go ahead.
Hi, sir. So first on the specialty chemical business, the capacity utilization that you have alluded to in this quarter for the entire year, if we do a back calculation, it seems our base business specialty, which was there till FY22, would have declined by anywhere between 45 to 50%. What has led to that significant decline, and how should we look at that business going ahead?
No, so when you talk of the base business, I think you're referring to our legacy capacity in Surat, right?
Yes.
Yeah, so there are two things that have happened this year. Yeah? There has been two sort of, one of our molecules in Surat has faced some demand challenges, which has started to recover, but during the year that has been the case. The other thing also to remember is that we ran several campaigns from Surat last year, which obviously have not seen themselves in this fiscal, but are expected to come back into next fiscal. The third thing is, I referred to the 4 molecules. Out of the 4 molecules, 3 molecules I believe are going to come in Surat. So all of that is going to bring business again in the base. So, some of the nature of this business is when it's campaign driven, you kind of tend to see that year on year, yeah?
Okay, got it. So secondly, on the HFO side, we had always spoken about the debottlenecking which was expected to come in CY23, and then we were also talking about a possibility of a phase 2. So where do we stand on that project?
So again, see, the thing is, I don't know how this gets. I'm going to clarify this once again. The debottlenecking was a project and is a project that remains in our hopper. It is not a project that is matured enough for us to even take it to the board. As and when that matures, we take it to the board, we announce it to the market. So that is a possibility in the hopper, much like a lot of other projects that we have in the hopper. We continue to look at these, develop this, and those become conversations with customer. Okay, so that is not to be taken as something that we have committed to. Yeah, and similarly is your question on the doubling the capacity of HFO, etc. I mean, our discussions with Honeywell, and particularly between Vishad Bhai and at the highest levels in Honeywell, cover a range of topics and range of opportunities. And depending on the market dynamics, those opportunities are being matured and will sort of see themselves come into play. Sorry, you want to add something? Will I answer your question to that?
Yeah. So just one last thing on R32 capacity. So going into CY28, is it fair that we will be operating the capacity at around 66-67% capacity utilization? Yeah.
R32?
Yes.
No. R32 is a low GWP product with a very long cycle. So its first cut starts in 2032.
No, but given that we have to produce the average of 24 to 26, so our average will be lower than what we produce in 25, 26. So technically from 28, our production will be around 67.
So what will happen is, we currently have a capacity that's already in play at 4,500, right? So that capacity is actually operating extremely well, and we may be able to do more than 4,500, but argument's sake, let's just hold that to 4,500. So that 4,500 goes into the quota as an average of 3 years production, so 4,500. With the current new capacity that we've announced today, we will be able to take in 2 years as opposed to 3 years, because that plant will take 12 months to commission. So by February, we commission the plant, which means we won't have production for 24, correct?
Correct.
But we have production for 25 and 26. The production for 25 and 26 will basically get divided by 3. So that's what will get into the system in 28. So to answer you in a more simple
I know, I got it, right.
Do the math for you is basically we are saying 9,000 metric tons will be our expanded capacity and 7,500 will be the quota to us from 28 on.
Yes, okay. Got it. That's very clear. Thanks a lot. Thank you.
Thank you. The next question is from the line of Vivek Rajamani from Morgan Stanley. Please go ahead.
Hi, sir. Thank you so much. So first question on your specialty chemicals and the CDMO segments. In 2Q, you'd mentioned you'd seen certain deferrals which you were expecting in this quarter. Just wanted to clarify if these are the same molecules which are continuing to see some sort of deferment or postponement even in this quarter. And if you could just spend a minute to kind of explain what exactly is the issues that the customers are facing with respect to some of these molecules.
So some of this it's a combination of deferral and mainly deferrals, and also in some cases we had to do more work on getting the chemical reactions right. But the deferrals are nothing different to what's happening across the industry at the moment. Everybody is looking at year ends and trying to reduce their inventory and costs of carrying the inventory, etc. So that's a deferral. It's not an order which is lost, but we expect that to be made up in this quarter.
Sure, so you mean Q4?
Yes, Q4, that's right.
Sure, sir. And the second question I had was, and I can understand this is a bit of a difficult question to answer, but just with respect to both your specialty chemicals and CDMO, would it be possible to give a sense of, how much do you think your portfolio is immune to these risks or deferrals, or how much part of your portfolio do you think is actually immune to such risks, and how much is actually, very, very reliant on, the customers, changing their views on demand? Would it be possible to give some sense there?
So I can't, again, as you rightly said in the beginning, it's a very difficult question to answer. What I can tell you is strategically, we try to play in products which go into early stage patented life cycles. Yeah, so that the risk of them being subjected to market dynamics, substitutes, etc., is reduced and is minimal. Okay, that's always been our philosophy, and that continues to be our philosophy. As Vishad Bhai tells us, he doesn't want to be in the Me Too business. So that is our thinking, right? But at the end of the day, the deferral again in CDMO, what you talked about. See, in CDMO, the deferrals are not actually deferrals. They are the nature of the business. The CDMO intermediate business runs on a campaign basis, and those campaigns are collected in 1 year, but then depending on how they are rolled out, etc., could take another year of gap and then come back to you. So that happens as a very natural part of the business. What we are seeing in the spec chem business is what's happening by global majors to control costs, etc., and manage their inventories, etc., as we get into year end and obviously look at these stocking effects, etc., which again you probably know more than what I do.
Sure, sir. Thank you so much for the explanation. Thank you.
Thank you. The next question is from the line of Chetan Thakur from Ask Investment Managers. Please go ahead.
Good evening, sir.
Good evening.
So just two clarifications largely. One is on the HFO plant. Just wanted to clarify. So this year we will be undershooting the optimum number that is there on revenue, and that should get back to that optimal number in FY25. Is that correct understanding?
So what I'm saying is that in FY25 we expect the peak annual revenue that we'd indicated in rupee terms to be met. In FY24, we will still be delivering the demand that Honeywell has put on us. So there is not likely to be any unmet demand. Like I said, as we speak and touch wood, the plant today is, operating at 80% of what we expect it to. So
the demand itself you mentioned is subdued. So that would mean that the number itself is lower than the optimal number.
So as you have this, Chetan, in any of these agreements, you have a certain minimum demand and a certain maximum capacity demand, right? Which you can't go beyond. What I'm saying today is that we have the minimum demand. If the environment was better, we would have probably seen it higher than that minimum demand. That's all I'm saying.
Understood. And so just on the spec chem bit, so the base business is expected to come back in FY25? and the additional 3 molecules that will get added, that will also start to contribute in 25. That should be a fair understanding over and above what we're seeing in today's numbers.
So over time, I mean, our philosophy is to optimize and utilize the assets across both the entities. See, we don't see this as a entity by entity conversation. We see it as a collective spec chem conversation on how to optimize the assets, whether they are in Surat or in Dahej.
Understand. No, just not talking about an asset level, but at an overall revenue level, the number that we are seeing today for FY24, for FY25, there will be a bump up which happens as the base business again recovers, which you mentioned right now. Campaigns come back, and you see one molecule.
So we have visibility to the next, this Q4 being stronger than Q3, and I'm saying visibility to that. What we are saying, and this includes the deferral of the molecule that I mentioned, okay, as a result of that too. What we also know, and in speaking with our customers, that the challenges within the spec chem business are going to play out, and recovery is going to be progressively better next year. But we expect that recovery to be better in the second half of next year rather than the first half.
Understood. And on the CDMO bit, again, FY25 will start getting more towards normalization, and we remain. We would adhere to the medium-term target of 100 million once this CGMP4 comes in place.
So directionally right. Again, we will have the efforts that we've taken, the agreements that we've done, including the 2 that we've discussed earlier before that Vishad Bhai pointed out. It will take some time for us to play that out. So, the CDMO business should start seeing in the way we've described to you, a stable revenue from commercial business with capacities that we use to get higher margin early stage products. That will start becoming more and more visible again as we go into second half of next year.
Understood. Sure, sir. That is fair. Sure. Thank you so much. All the best.
Thanks.
Thank you. Participants, you are requested to please restrict your questions to 2 per participant. You may rejoin the queue for follow-up questions. The next question is from the line of Archit Joshi from B&K Securities. Please go ahead.
Good evening, sir, and thanks for the opportunity. I just had a few fact checks, especially in CDMO. So we've had a few announcements in the past. So there's been a contract that we signed with Fermion. Then there was this discussion about the $16 million PO with an American company, and now we're speaking of expansion of the MSA with one European customer and the commercial opportunity that we have received from an American customer. Is there any overlap within these customers?
Definitely overlap.
Yeah. Right, sir. So the European
definitely overlap, Archit. The first name that you referred is actually the European-based API. We had signed an MSA with them covering 1 molecule. Now this expands it to 2 molecules, 2 more molecules. So in total 3 molecules. Yeah. And the American CDMO is something very new. That's absolutely recent. We've never announced that before. That the partnership there is very promising because here we're tying up with a player who's got the skills or experience in the early stages, and we've got experience and capacity in the commercial stage. So, this is going to be a complementary partnership, both in terms of how we utilize our common, capacities to our capabilities in a more complementary manner, but also it will open up access for us in the U.S. markets to customers,
Got it, sir. And with the same American partner that we are speaking of, we have intended to commission around 160 crores in phase 1, which I think Vishadji mentioned earlier is towards this particular contract. But the total capex number being 288, I was just wondering if there are 2 dedicated blocks separate to service different customers, or how should we read this?
So, actually, let me first sort of clarify this. Okay, in CDMO business, we do not have any dedicated blocks. When we say dedicated, what we mean is we've allocated the capacity. There's no concept of dedicated plants. There's no concept of take or pay or anything of that sort. Okay. The other thing that you talked about was the reference you made to, the phase one. The phase one supports the European-based API customer and not the American one. The third thing to point out is we have not entered into a partnership with the American one. It's a strategic partnership, which means we have an arrangement of mutual, beneficial, commercial arrangement that we will tap into our respective capabilities and see how to maximize the value of that relationship.
Got it, sir. And just one last clarification I wanted to squeeze in. Earlier, just picking up cues from the previous calls, I think the multi-purpose plant that we had announced our capex for, we had close to 3 molecules towards agri, and I think one was in the pipeline which was supposed to go towards pharma. And now we're speaking of 4 more molecules, I think, which takes the total tally to close to 7-8 molecules. So these new 4 molecules would effectively come under the same ambit of the total potential that we are talking of, let's say 60 to 70 odd crores. Would that be a fair assumption?
No, so again, what I think I'm mixing two things up, because the MPP one plant had certain molecules that have been brought into play in the Dahej, and that was an indication. Your first comment relates to that. I think the second comment, which I was talking about, 4 new molecules, as I said, 3 of those are actually coming in Surat, and 1 is being introduced in the Dahej. So they are mutually exclusive in that sense.
Oh, right, sir. That helps a lot, sir. Thank you. Thank you, and all the best.
Thank you. The next question is from the line of Madhav from Fidelity. Please go ahead.
Hi, am I audible?
Yes, you're audible, sir. You may proceed, sir.
Yeah. So my question was on the R32 capacity. Just wanted to understand, given that we are actually, first question here is, why didn't we announce this 4,500 tons earlier and then, make use of the quota for CY24 as well? Because this baseline period has been known. So I'm just wondering why announce it now and not earlier, and then sort of let go of 14, 15 months of production for the quota.
So again, a good question. I mean, I think, this is something that is a homegrown developed technology. Having done the first phase gives us significant confidence of having gone into the expansion. So one driver is that. Second, we believe that the R32 pricing environment will see a similar pricing environment that you saw in R22 as the quotas kick in, etc., etc. Third, we know that it's a low GWP product, so it has a longer play, apart from having a play in the transition to HFO eventually, whether in India or outside. Yeah, outside there's a likelihood overseas of it being used in blends. Similarly, in India, that transition will also go to blends, etc. So we have strong belief on the demand for this. We also think that this is very strategic for us in the sense that it secures our play in the industry and the market position that we have. So, to answer your question in a simple way, better late than never, no?
Understood. And when you say pricing should be like R22, basically, you're saying that once the quota, etc., is frozen after CY26, as demand kind of grows, because India should and the world should see good pickup for R32, as you mentioned, across various blends, etc. So you're saying that's why demand should be quite tight for this product longer term. Is that how we should read it?
Yes. So both the demand side, and also I meant that, you've seen in R22 that every time the quota kicks in, the pricing sort of becomes more tighter, right? And more stronger. So that's what we expect to play. Of course, this is a long play, yeah? So things will pan out as they pan out, but it's not unfair to expect a similar pricing curve that you saw in R22 in R32. You would expect to see something similar play out.
Got it. All right. Thank you.
Thanks.
Thank you. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi sir, good evening and thanks for the opportunity. Sir, just first is on taking from the previous question itself, sir. So R32, you have mentioned that the current capacity have been fully utilized. While we understand that the industry scenario still remains weak and there has been significant capacity additions has happened. Just wanted to understand, sir, what is driving this demand, whether it's a domestic exports from where it will primarily coming from the exports market or what is the driver?
So first, the 4,500 we talked of is absolutely we've had very good response, and the uptake is very good. So that is not a question. And also in our conversations, both within the industry and globally, we believe that R22 has a very unique play in the transition. As I mentioned earlier, the blending opportunities will increase. The given one, it is low GWP, and it is a fairly competitively priced product compared to HFOs. So, you will see it being played more and more in the blending philosophy, even globally. Our also view is that India itself will have short, capacity to meet the demand from 28, 29 onwards.
So my question was around the current demand environment of R32, which you have mentioned that the plant is fully utilized. So.
Yes, the current demand is fully utilized. It's not a problem. My reference on pricing pressure was in relation to R22, unless I don't know if that was what was driving the confusion.
No, sir, I'm talking about R32 only, and just wanted to understand what is the driving factor for R32 which has led to full utilization at our plant.
Driving factor is, there's enough demand. I mean, sorry.
Okay. Sir, second question is on your seed.
So R22 is also being exported, and as you know, even in US, as the restrictions kick in, I believe it's from 1st January of this year, the blending potential for R32 will also increase, like I said before.
Okay. Sir, second question is just some clarification. Hello, sir, can you hear me?
Yes, go on.
So second question is on the CDMO US-based new contract which we have done with. So just wanted to understand that about a little bit more about this new customer, the kind of chemistry which we will be doing here, and the kind of investment which we may need to put for this CDMO CGMP facility. If I clarify, the 288 crore rupees investment which has been approved by the board, it does not include this US-based new customer coming in, right?
So can I just clarify, the US-based partnership is with another CDMO player. It's not a customer. There are two capabilities here. We bring in fluorination capabilities apart from other chemistry synthesis that we are good at. Those players, the CDMO in the US, also brings in their unique capabilities to the table. They bring in their access to the US market. We are stronger in the Europe market, so we bring in that. So I think it's a partnership in that sense where we share the chemistry capability with each other, we share the market capability with each other, and we allow access. So it's an enabler to future growth. There is no investment involved in that. The European-based MSA, which is a customer where we have to do investment. So the 160 crores supports that investment, that MSA.
Okay. So that's it from my side, sir. Thank you.
Okay, thanks, sir.
Thank you. Ladies and gentlemen, to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. You may rejoin the queue for follow-up questions. We have the next question from the line of Diresh from White Oak. Please go ahead.
Yeah, thank you. So, Anish, when you were explaining the project's revenue potential, the key projects that we had undertaken in the last few years, I just want a clarification on that. So, Orchid is where we are saying 400 crore revenue potential, right?
450 crore is the peak annual revenue is what we are saying.
Understood. And this we expect to do in FY25?
Yes.
As per current understanding.
In FY25.
Okay. MPP, which was supposed to be 280 crore as per my understanding on an annualized basis, we are saying we are running 80% of that in current year and will do full in FY25, right?
So MPP one, which you said, that was I think 260 to 280 crores as far as my memory goes, and
Okay.
I'm saying 80% of that. Yeah, that's right.
80% in FY24 we will do.
Or, as I said, it's the range, 260 to 280.
Yeah, understand. I understand. Not holding you to a point estimate, just the corridor I'm trying to
I'm
understand.
giving you a broad sort of indication that, while we have had, we would have thought that should have come in this year fully. It has slipped slightly, but not materially.
Totally understand that it's not a point estimate. There will be a corridor around it. Understand that. Fresia, which is agro intermediate, that was supposed to be 160 crores. That we are already done full revenue this year, right?
That's correct. That we expect by
Nectar?
end of FY24.
What about Nectar next year?
So Nectar will have 2 years to run its par once it comes into play, which again I think that as we see today, that's the target.
FY26 is when you expect to hit 600 crores, huh?
So if we are saying the chemical reaction we said will start in March or end of March, and with first supplies coming in July, for all practical purposes, I would see the 2-year period being FY27. That's when you should start to see or expect to see peak revenues.
Understood. Okay, thank you.
Yeah.
Thank you. The next question is from the line of Ranjit from IIFL Securities. Please go ahead.
Yes, sir. Thanks for this opportunity. My question is largely on the thought process. Earlier, we were only kind of sticking to R22. Now, over the years, we have seen kind of a diversified to HFO, and now we are also getting aggressive in R32. How do we see the refrigerant space evolving probably 5 years down the line? Is there a plan to further diversify into more refrigerant, given that we have an HF capacity coming in the age in 3 years time frame? Thank you.
So Ranjit, again, if you look at the refrigerant growth space, even in India, it's growing at double digit. R32 is also having a CAGR globally of double digit. Will we remain in refrigerant space? We were pioneers in that space. I think it makes sense for us to remain in that and play into the transition from high GWP to low GWP to eventually HFO. So we will be playing our part as a player in the industry in that transition. I don't think we've ever said we would not do that.
So will that also pave way for our entry into blends in future?
I can't speculate that, but I'm kind of saying the whole landscape is open depending on what opportunities are available and how our capabilities are geared to tap into it.
Yeah, thank you. One last...
we will move fast wherever we see the opportunity is right and, our capabilities meet that.
Right, understood. And any plans on utilization of HF capacity that is likely to come up in a couple of years at the Dahej?
So it's a mother plant. Lots of things are being worked in the hopper and lots of things will be progressed in a progressive fashion. But we've consciously put in the capacity to ultimately use the downstream ability. We are, and I think we've said this before, we will be looking at emerging sectors, etc., as we progress into the future. So, some of that will play out as well.
Hopefully, we should hear in next year, next fiscal, some announcement on this.
I'm not going to second guess that now. It will be when it will be. Sure. We are working at it, believe it. As soon as we can talk about it, we will talk about it.
Right. So the question was because even on the CGMP4, we have kind of give out a 3-year time period to kind of have phase 1 and phase 2. So whenever we do make an announcement, even on that new emerging opportunities, one should take a similar time frame. So that was the intent.
So I mean, again, I know what you're saying there, but the intent is there. We're working it. It's in the hopper. I mean, I don't know what else to say at this stage. It'll come when it will come, Ranjit. But it's not something that we've lost line of sight to. We are putting a lot of effort internally to progress that area. So if things materialize, we'll probably hear on it sooner than later.
Right. And finally, from the gross debt level, can you share the figure for the...
Sorry,
The gross debt figure of the December ending quarter.
Gross debt figure is 1,200 crores, including, I'm talking the expanded debt, including what we take borrowed on working capital, yeah?
Thank you, sir.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
All right. I would like to thank everyone for taking the time out and joining the call today. I hope we've been able to respond to your queries adequately. Thank you all. Have a good evening and good night. Thanks.
Thank you. On behalf of Navin Fluorine International Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.